What's up, everyone? It's early morning during tax season, and I just thought of a new way to explain the schedules L, M-1, M-2, Schedule K, even tying it to the 1120S. It's always, as I started doing taxes a couple years ago, it's something that I can understand when I need to, but in the way I just thought of it, it kind of tied everything out well, and it's like a step by step, like this goes to this, to this, to this, and I think it'll be really helpful. So I'm going to walk through it with an example from a return I did for 2023. I hadn't, done the books. It wasn't a client that I normally worked with, but this was a good example. Okay, so first we always start with the profit and loss. Generally, the profit and loss is what you're reporting on your tax return. So we'll start with it. So the company had $4.1 million of income, almost as much in expenses. So they had a book profit of $73,600. So this is important to understand. There's going to be differences between what's on the books and what's on the tax return, but it's all reconciled out on the tax return. So if you've been doing taxes at all, and you probably have been if you're here because you wouldn't think to look at this on your own, you've heard of things called separately stated items. So this is an S Corp, I should have mentioned. So they get a K-1 from it that shows, income, expense, and separately stated items. So one of them you should know is charitable contribution. So if you donate money through an S corporation, it's not really a business expense. It's a charitable deduction opportunity that gets passed through to the owner. So that was $13,000 for the year on the books. That's separately stated. And then also interest income. So we have $72 of interest income that gets passed through as well, separately from ordinary S corp business income. Now, I've also highlighted meals and entertainment here of $13,924. And if you've been doing taxes, you know that it's only 50% deductible, unless you have a special reason why it's not. So meals basically are 50% deductible. Entertainment would be 0% deductible. So we have $6,962 of this that will be deductible on the tax return, and then obviously this other half that won't be. So now let's look at the 1120S. So when we just look at this right away, we see the income, the summary of income and expense, and the ordinary business income is $93,500, which is quite a bit more, 20 grand more than net income on the profit and loss. So why is that? Now, if you've been doing taxes and you're here, this is obvious to you. It's because of those separately stated items and the meals that are only 50% deductible. Like, everyone knows that, but then it's where it gets confusing. At least it did to me, and I think it does for others too on these schedules below. Okay, so we start with this. We've plugged in those separately stated items in the right place in the tax software so that it's not actually showing this, which is good because interest you do on a K-1 section. Charitable contributions is the same. They're separately stated items, okay? So now let's scroll down. So, this is the 1120S. Now the first thing to look at, and how I like to look at this now, is the Schedule K. So right here we start with the ordinary business income that was showing on page 1. So that's $93,500. You remember that? And then now we're basically saying, okay, so that was what's taxable, but now we have to add in these separately stated items so that we can begin to reconcile this, like, what's on the books and what goes on your K-1. So we would add in $72 of interest income because it's more income that you had, okay? And then we would remove the charitable contributions. I screwed something up there. Oh, I guess I just never added it to, let me just redo this here. So 93,552 plus 72 equals that minus 13,026. Okay, so now we're left with 80,598 between these items because we're adding in the interest income and we're subtracting the charitable contributions because it's like it was a business expense. Now there's other important items here like the distributions and then the half of the non-deductible expenses, but it doesn't impact what we're doing here, so we'll come back to it. Again, similarly with this other information, this is like informational only. It doesn't go into this. So now here's the box that I find interesting. So it says income loss reconciliation. Combine the amounts on lines 1 through 10, which is the income plus all these other things of income, and then you subtract the amount on lines 11 through 12D, and then also 16F, which you probably won't have. So subtract just the deductions. So that's exactly what we did here. So now we're at 80,598. So we now have, kind of tied out our ordinary income added in our interest expense and subtracted charitable contributions. So hang with me here. We're about to make it make more sense because, this still doesn't equal our net income. So what's the deal, right? Okay, so now here's the Schedule L. We'll come back and look at this later. Now, this is where it begins to tie everything together and make sense to me. So this says, we'll zoom it in. This says the income and loss from Schedule K, line 18. So that was actually what we just did. Where did we go here? Sorry, line 18. So 80,598. 80,598 goes here. So what's the significance of this? So the Schedule M-1 is the reconciliation of what your books say and what your tax return says. What you're going to be taxed on versus what the book said, right? So here we had 73,634. Here, anyway, we'll get into this. So okay, so this goes after the separately stated items are added, and then we work backwards from it. And you don't think of looking at this backwards because it goes 8 to 1, but really we're starting with the end in mind here. So really all that gets added in that we haven't yet is this. So it says expenses recorded on the books, not included on Schedules K, lines 1 through 12. So basically it's saying if it's not in this, what was an expense on the books this year not included? And that was the $6,962 that we had calculated. It was the half of that meal value, right? That number should look familiar. So we're subtracting this 6962 out. And it looks like if you go from the normal way, but either way, at the end of the day, you'll see that this now equals it, right? 63,634. This is due to rounding, so it's $2 off, but that's okay. So basically, if you look at it this way, okay, here's what the books say, and then we have to add in half of our meal expense because it's not deductible, and then we end at 80,598, which ties to this, which then says we need to add in these things to the K-1, and then we get to our ordinary income. So now let me show you the K-1 quick so that makes a little bit of sense. The only tricky part is this is a 50-50 owner, so all these numbers are in half. But basically, this is that 93. If you double this, it's like $93,000. So that's that full ordinary income getting passed through. And then this is half of the interest income, so it'd be $72. And then this is half of those charitable contributions. Sorry, that's not half of the charitable contributions. This is half of the charitable contributions that get passed through. Okay, so basically, we're reporting the full amounts, and then we get these deductions and the added income on it. Okay, so now we know how this ties to books. So when you're trying to understand this M1, because it can apply to the M2, just think of it working backwards, and this is from Schedule K. This should always equal what's in your books, otherwise you screwed something up. If this doesn't equal your bookkeeping, something's wrong. Okay, now on to Schedule M2. So Schedules K is about getting the K-1, right? Schedule M is about tying it to what's in your books. And Schedules M2 is to kind of look at the money you've already been taxed on to say, okay, what can you take out without getting taxed again? It also kind of tracks your, well, I'm not going to say it tracks your basis because that's what 7203 is for. Okay, so this is an example to use, which makes it tricky in some ways, but this is, why people are looking for this stuff. So the balance at the beginning of the year was 0, and it's 0 at the end of the year too. And it's because your M2 account, it can go negative, but it can only go negative by a loss in the business. So if this started at 0 and then we lost 50 grand this year, it would end at negative 50,000. Okay. But that's not what's been happening in this business. What's been happening in this business is the business makes like $100,000, but then they pull out like $200,000 in distributions. And you might say, how do you do this? It's because you get debt. If you look at the balance sheet, there is 236 grand of debt, 138 grand of debt. So that's like over, almost $400,000 of debt. So if you take debt, you can pull out distributions. The IRS doesn't like this. And I'll explain that shortly. Okay, so we started the year at 0 because last year they had more distributions than they had net income. And sneak peek, you see it's going to happen again. So the ordinary income from the year was that 93,552. We keep seeing that, and that's what's at the top of the tax return. And then there's additions and subtractions. So they're basically saying, okay, we know it wasn't in the ordinary income for the year, but you got interest income and it was in the business. So it's like earnings that you haven't taken. So it adds the $72. Okay. And then now it does the other reductions, which I don't have the statements pulled in here, but the other reductions are the they total to 19,988. And let me show you what that ties to. So what it is it is this amount, this charitable contributions, and that makes sense because they took it out of the business. It wasn't a business expense, but they took it out of the business. They're getting credit for it. And then the other thing they took out of the business is this non-deductible expense, which is half of this meals. So half of the meals that aren't deductible gets added in, and then we're at 19,988. So that gets subtracted. So then basically the net of these three items, the net income plus the interest minus these other reductions, is now 19,988. And that nets us to $73,636. So now when you look at this, it might look really clean. Oh, wow, they just took all the distributions that they made and it ends at zero. That's not actually what happened. So let's start at 73,636. So that's what it was before distributions. If we go up to Schedule K, we'll see that their distributions were actually 161,618. So it's a lot, obviously, bigger than $73,000. So what happens was, and their Form 7203 is what tracks basis, but it matched this exactly. So when you subtract 168,000 from 73,000, you have negative 90,982. But you see a zero here. And why is that? It's because, like I said, business losses can make this negative, but distributions cannot. So we take out the losses and other items first, and then we have whatever basis we can subtract distributions from, and then we subtract them all, and whatever left is now negative basis, which is impossible. So what happens is, and this is important, you probably know this $90,982 becomes a capital gain on the personal on the tax return of the person who owns this S corp. So when they get the K-1, they're going to have their 7203. It's going to show they have distributions in excess of basis, so they're going to have to take a capital gain. So there's 50-50 partners, so this would get divided by 2. So each partner would add onto their Schedule D on their 1040 return a $45,000 capital gain. So they're essentially like buying themselves basis by doing a capital gain. That's just the rule. It's interesting, but it makes sense that you're not just starting a business, taking a ton of debt, and then taking all the money out. So that's the thing. So this gets limited to 0. So the next year when we start, we're going to start at 0 again and do the same exact thing. And I just hope that this next year we'll have more income than distributions, and then we'll have a positive balance here. We won't have to take a loss. Won't have to take a capital gain. Okay. I'm going to wrap this up shortly here. Schedule L, this you're probably wondering, this is like, my main focus has always been like trying to understand the Schedule L to the M2, but then showing these other parts helps it make a lot more sense. The Schedule L is the balance sheet per the books. So it can get really complicated if people do like different book depreciation versus tax. I just worked on one of those. But basically this balance sheet, and I didn't download the balance sheet, but it should match the books exactly. Now, when you don't have someone taking distributions well beyond their basis or their M2 account, this number will usually be positive, and then oftentimes it will match this retained earnings, but it doesn't have to. People get hung up on thinking that this number should match this number, and I love when it does because it makes it really simple and it's an easy check. But these are all standalone statements. Like this is on its own. This is on its own. The 7203 is on its own. This is just a calculation each year, just like the Schedule K. So this retained earnings is literally just what shows on the balance sheet in the books for retained earnings. So the reason this is negative and this is not is because basically we've recognized, these clients have recognized this much capital gain over the last 3 years. And that's just the way that it was. Let's see if there's anything else to say on this. I mean, I won't do a whole video on a balance sheet, but basically that you have your assets, liabilities, equity. Your equity has to equal the A plus E plus L or whatever, right? So this negative retained earnings is huge, and it's just a function of not having many assets in the business, having a ton of liabilities. the net has to be to retained earnings. And if you go look at the financials of the company, the story will tell that. So that is basically how all these tie together. It's a lot. I hope this helps. It helped a lot when I thought of it this way this morning. Leave a comment if you have a further question, or if you want to tell me you have another idea. So thanks, everyone.